Yogesh Patil, CIO Equity at LIC Mutual Fund is now joining us. Yogesh, I want to talk to you about the rural and the tier 2, tier 3 space in particular beyond consumption, because the sense is that the government may actually put extra effort and liquidity towards that side to revive. What are the categories which are likely to do well? Is it rural pumps, or is it some of the companies which are providing water solutions, or maybe some irrigation companies or pipes? Which categories in your view think could be a beneficiary?
See, if you see, the rural is largely driven by basically agriculture, right? So solutions regarding agriculture, like you rightly said, pumps, pipes, credit, mass housing, and employment generation. These could be the focus area for government in budget, it looks. And if you see the large part, they are also struggling due to poor income, poor non-agri income. So government will again focus on that area as well.
How are you? Also, I want to talk to you about the auto ancillary space. OEMs are what, about half a dozen OEMs, but there are about 30, 40 auto ancillary companies, some of them small but doing phenomenal work on technology front. So it's a stock specific kind of a play. But would you go for auto ancillary which are dedicated to two-wheelers or CVs, or you would go for companies which are integrated, providing to all? What kind of auto ancillary would you play on?
See, obviously, we would like to pick those companies where addressable market could be very big, and in because of China plus one, some of the auto ancillary getting a much bigger market, and they can serve domestic market as well as global market as well. And some of the are also present in basically defense also. So we are looking for diversified kind of ancillary companies where the risk of one segment, maybe domestic auto or maybe or any other risk, could be very less relative to other auto companies.
What are your approach on capital goods space? Are you going top quality, top tier, but then the valuations are more 50, 60 times, 70 times in some cases? Or are you also open for mid-tier engineering, which are feeding to other larger industries, but valuations on the lower side relatively?
Definitely. India is heading for a big capex boom. So till now, our gross fiscal capital formation is 92 lakh crore. Out of 40% is household and real estate, 10% is social. So remaining is 50% is basically private and government capex, which is somewhere around 45 to 46 lakh crore. But if you see the government plan on most of the corporates and majority of the capex plan for next 6 years for private and public is somewhere around 90 to 95 lakh crore. Is largely driven by power sector, railways, defense, data center, PLI schemes, and other oil and gas and pharma companies. But if you let's take a power sector which is bigger now. So you have opportunities in basically balancing power plants and renewable power transmission, distribution, their ancillary companies. So you can play the overall theme in any company based on your choice, your valuation, and your comfort. Basically, you don't need to go for only some few companies where others are or maybe others are very much present or in crowded space. So you have a huge opportunity, and this time government has clearly mandated domestic manufacturing. In previous power cycle, most of the ultra power projects and your 360, 768 kV transformer is actually supplied by Chinese and Koreans. This time nobody is present. So it is completely domestic story with a large opportunity. So opportunity is very big and it is available for everyone.
Is the ignored market, unloved, unadmired part of the market in your view right now?
Consumption space, mass consumption is actually completely ignored because of, if you see the last 2 3 years, because of lower income, high inflation, especially rural consumption was impacted. But I think things are changing because of the government initiatives, higher MSP prices, normal monsoon, and obviously pickup in job and job related sectors actually slowly, especially PLI schemes, manufacturing focus from government. Actually, this will create a higher jobs and improve the per capita income. So mass consumption category, which has not done well in last 2 years, I think is expected to do well in coming years.
Just talking to Vinayak Chatterjee of Feedback Infra just a while back, and he was making a case that this budget we may actually see disproportionate focus on railway capex. Up till now, infra and roads have been the biggest focus. Now, when you talk about railway capex, there are wagon companies, coaches companies, air conditioning, in these new age trains which we are talking about. How should one go about, or signaling companies, Kavach, etc. plays? How should one go about playing the railway space best?
Definitely. The space is very big and so many things are happening first time in India. So companies in India are not prepared for this kind of businesses and growth. So slowly, domestic company will do tie-ups or may they take some technology and then they participate. And some of the MNC companies actually they already have technology and done doing business in Europe and US. So definitely both will participate. We need to check is a obviously stock specific game where the companies are comfortable, their management capability, their project execution capabilities. We need to check everything actually. And first time after so many years, railway is actually awarding tenders and paying payments on time. So is actually a real capex story. But we need to again is a I said stock specific market and the company specific because there are so many businesses where companies are not present and they're just entering first time. So maybe next 2 3 years or 3 4 years they will not make money actually. I can't name the companies, but there will always be a learning curve there, and because of lower operating leverage and learning curve, it may take some time to show the earning growth. So I should focus towards the good management and where the companies have capability to execute the project and orders.
Uh, is valuation becoming a challenge, or this is a myth? Because one section of the market believe that there is froth now, everything is fair value and above. It is difficult to really find bargains in this market. What are your thoughts on that?
See, definitely valuations are gone up in last 2 3 years, especially in capital good engineering sector. But the kind of opportunity is offering is very big. One need to take a slightly longer view. Definitely, the easy making money is already over now. But considering the capex plan, investment in power sector, data center, railways, PLI, and defense it gives a very big opportunity. And I think in some of the sectors we are anyway running out of the capacity basically, especially in basically genset, transformers, power equipments. So it offers a very good opportunity, but at the same time, the companies need to do capex to boost the profits. As of now, the capex is largely coming from actually selected segments and companies. And I think as things progress, definitely company will do more capex and their earnings will grow. So it is always say take some time to justify the earning and growth. But some of the investors want to take a 5 year view. So definitely, they also have different criteria. But one thing is very clear because of the focus on manufacturing, the India image is completely changed for foreigners actually, and domestic investor also getting more clarity on the capex part. So yeah, if anyone has a view, definitely 3 to 5 years, it makes sense. But it is again a stock specific market, and every segment actually generating a good earning growth. As long as earnings will come, definitely these valuations will continue for some time for some companies, not every company, because what price you pay is also equally important. But considering the size of opportunity in some segment, I think it's okay to get normalized return from here.
Before I let you go, how do you think should one approach financials? There is one part of the financial which is insurance, not done too well lately. Private sector banks again split into the good performers and not so good performers, and then there are PSUs, but also asset management, wealth management, market infra related financials are also there. Should one adopt a basket approach, a little bit of everything, or which part of the end of the market is likely to grow fastest on earnings?
See, definitely considering the capex, the large part pie would be captured by NBFC, those who are funding infrastructure projects, power projects, and the second is basically consumption part. So I'll bifurcate in two things. The PSU banks actually largely shown a very good performance in last 2 years because of the two reasons. First is valuation was very attractive, and second, improvement in profitability led by recoveries or improvement in credit cost. So from here they will normalize, and as and when consumption will picked up, or the consumption driven loan picked up, so definitely private sector banks, considering their valuation today, and they are not done well in last 2-3 years also. So considering their valuation and ability to perform better in terms of, compared to PSU banks.
Right. All right, Yogesh, we'll let you go on that one. Thanks so much for joining us
Thank
on
you
the
very
show
much.
today. That was Yogesh Patil of LIC Mutual Fund.
If you like this video, then like, share and subscribe to ET Now.